In a recent BlackRock survey of registered voters, more than 75% of retirees said they wish they had saved more money for retirement. And with the recent passage of the Secure 2.0 Act now in effect, opening up new opportunities for savers, investors are considering how to save and build wealth for the future. So how can investors ensure they're pulling all the levers at their disposal to retire on their own terms?
The best part about retirement is it's one of the few universals. The question is, what does that look like for you, Oscar, or what does that look like for me? And the only thing I can tell you right now is it's going to look different for you, and it's going to look different for me. It's going to happen at a different time. It's going to happen with different aspirations. But helping people save, and then savers become investors, tap into the power of capital markets, and then those investors, compounding over time, become spenders to fulfill their dream, is really what retirement is all about.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Coming up, I'm joined by Rob Crothers, head of U.S. retirement for BlackRock. Rob will discuss the current state of the retirement landscape and help us unpack a toolkit for retirement savers that's been proposed by the Bipartisan Policy Center and how investors and employers can plan for the future. Rob, thank you so much for joining us on The Bid.
Oh, thanks for having me, Oscar. Great to be here.
Rob, the topic of retirement is a topic that we've been covering on The Bid periodically over the past year. And really, I'm thinking back to the episode that we did with Larry Fink when he wrote his annual letter to investors in 2024. And retirement was a big headline in that letter. So since then, it's, again, been a recurring topic. Talk to me a little bit about the current landscape of retirement and what's changed over the past year.
There's a lot going on. Retirement is certainly core to everything that we do at BlackRock. Half of our assets are retirement related. When I think about what's going on in the U.S. specifically, which is where I'll spend most of my time, I'd say retirement is building from a strong foundation. I think one of the benefits that we have is over the last couple of years, we've seen two pieces of really generational policy come out of Washington. We call them the Secure Acts, but it's setting every community up for retirement enhancement. Secure Act 1 in 2019 and 2 in 2022 that have really laid the foundation for the modernization of the retirement system in the U.S. So we're covering more people than ever before with workplace retirement plans. When you have access to a plan, you're 80% more likely to save. We've got best practices that are really being embraced by corporate employers in helping their workforces save. And then you're thinking about what more can we do? So how can I build from that strong foundation, add things to help people prepare for and save for emergencies? How do I help cover more people in the workplace plans that exist today? And then things like how do I offer retirement solutions that aren't just saving solutions, help people spend in retirement, help people live the life that they want. The best part about retirement is it's one of the few universals. Everybody that's working today aspires to retire someday. The question is, what does that look like for you, Oscar, or what does that look like for me? And the only thing I can tell you right now is it's going to look different for you, and it's going to look different for me. It's going to happen at a different time. It's going to happen with different aspirations. But helping people save and then savers become investors, tap into the power of capital markets, and then those investors, compounding over time, become spenders to fulfill their dream is really what retirement is all about.
It is hard to find something that almost everybody agrees with, but it does feel like most people agree with. And I know that BlackRock recently hosted a retirement summit in Washington, D.C. There's a new paper that you and your team have co-authored with the Bipartisan Policy Center, which was an important stakeholder in that summit. Talk to me about the paper. What was the genesis, and what are some of the recommendations that are talked about in this piece?
No, it's a great call out. So start with the summit. The summit earlier this year was BlackRock acting as convener, right? So we didn't show up with answers. What we showed up with was a call to action and a big statement, right? Question statement. The question is, what more can we do and how can we do better? And the statement or call to action is it's all of our work, right? So everybody in that room, and that room was policymakers, small business owners, industry participants, people involved in retirement, everyday other asset managers, with a broad form objective of having the conversation. The paper really is to build from the momentum of that moment. The paper itself really goes through a series of broad form recommendations, but the idea that as a group we can provide more access to workplace plans. So today, 56 million American workers don't have access to a plan from their employer, right? Think your gig workers, self-employed, et cetera, so on and so forth. That's despite people being 80% more likely to save for retirement when they have access to one. So we know it works. It's just a question of how do we expand that to more people. Things like how do we instill and build on the best practices that exist when people do have access to a plan? Automatically enrolling individuals into a retirement plan, for example. When you automatically enroll workers into a retirement plan, 95% of them participate. When you leave them on their own to opt in, only 2/3 participate. Right. So the idea of using best practices, not just to help people save, but also things like reducing plan leakage, helping people take retirement plans with them. So for every dollar people under the age of 50 save for retirement in any given year over their working life, something like 22, 23 cents of that dollar leaks out of the retirement system because people have to withdraw early or tap into it for emergency savings, et cetera, so on and so forth. So, foundational things, I'll give you a couple examples there of, how do we build from what's working, and then how do we take best practice and really instill it in the ecosystem to bring more people into retirement savings, and then once they're there, help them achieve the goal that they want.
Rob, what you're describing sounds like if there are certain mechanisms put in place, it encourages better saving behavior for retirement. I think you started to touch on a few of these, but just elaborate a little bit more on what some of those mechanisms might be.
No, it's a great question, Oscar. So it's not just a single tool, right? Think about it as a broad toolkit that employers can use, but individuals can use too. The first is as I touched on a bit earlier, things like automatic enrollment. So when you have access, making sure that people contribute. But I'd add to that in the defined contribution space, things like the default investment concept. Today, 96% of U.S. retirement plans, corporate retirement plans, use the target date fund as the default investment. A relatively simple, low-cost, professionally managed, risk-based solution that allows an investor to take different and appropriate levels of risk across their investing life cycle. Default, very important. The idea of what we would call automatic escalation, that once I've contributed, say, starting at a 3% level, standard contribution rate, over time, I can afford to take that 3 and make it 4, or take that 4 and make it 5. And in an ideal world, that's compounding alongside wage growth. I'm making more money at the same time, so that 4% is of a higher numerator as well. So I think think about the toolkit as things that can be used, relatively simple things, but best practice to encourage investors to not only save more and save often, but once they've saved, invest in appropriate things that help them grow their wealth, tap into capital markets, and ultimately grow their retirement savings.
And we've had conversations with guests in the past about how investing is a very emotional exercise, and it sounds like some of the things that you're describing try and take a little bit of the emotion out of it and hopefully lead to better outcomes in the longer term. Rob, in the paper, there are recommendations that go beyond retirement saving specifically. So maybe you can talk about some of the other mechanisms or tools that are in there that talk about how you build wealth over a lifetime.
The first thing anybody should do is to save as much as they can, as often as they can, as early as they can. It's not really a tool or a recommendation, rather than the power of compounding in capital markets is amazing when you think about a 30, 40-year investment time horizon. We have lots of conversations with employers about things like emergency savings. Individuals, a Federal Reserve estimates fewer than 20% of adults say the largest expense they can can handle in an emergency is only $100. That's a challenge for people. If you can't live today, you're living paycheck to paycheck, saving for an outcome 30, 40 years in the future, I think is incredibly difficult. So again, we've done some work with some organizations through our foundation to build emergency savings into retirement plans. I have some great conversations sometimes from my seat. And one of the best was recently was with a large employer, retail-based employer. They have corporate workers, those in management, and then they have, your line workers, manning the cash register of the store. And as they think about retirement, the biggest thing that they would acknowledge is that there isn't a homogeneous population there, right? The challenges that someone in management faces in saving for retirement are very different than the folks that are working in their stores day to day. And in adopting something like emergency savings, for the vast majority of their workers, the first period of financial stress they have, they cash out their 401k, and they never come back. Right, so they're talking about how do I help supplement, my benefits package to add emergency savings? I would add too, in addition to investments, focus on income and retirement. So income is perhaps the most talked about outcome in retirement space today. We as individuals, to your point on the personal nature of all of this, are very anchored on what's my retirement balance, but we've not conditioned people to think about translating assets into income. And you every day in your working life get a paycheck every 2 weeks or every month, so you have income. That translation point from assets to income is actually quite challenging for individuals. So we did some research a couple of years ago where 20 years after retirement, the individuals we surveyed working with Ebury had 80% of their pre-retirement savings. So 20 years into retirement, they still had 80% of their money left. The idea underneath all of that is they're likely underspending in retirement. But how do you help people spend? A little bit of guidance, modeling, tools, potentially advice in some cases, but also through solutions. And when I say income, the idea of lifetime income or guaranteed income, akin to what might have used to be the case in a defined benefit plan, but delivered through a defined contribution plan is certainly a big topic today.
You covered a lot of things there, Rob, and I'm going to go back to what you mentioned about the emergency savings, the very small amount that can seemingly crop up in somebody's life and then requires them to tap into their retirement plan. And then it's sort of a bad spiral. And perhaps one of the ways to get people behaving appropriately is to do it at an early age. And I know that at the summit, there was discussion, and there has been amongst policymakers as well, of how do you encourage better behavior, better savings behavior at an earlier age? What should parents be doing with their kids to encourage better habits of wealth building at a young age? What can we be doing at that stage of life?
I love the question. So I've got a 10-year-old. I know you've got kids as well. I think talking about money with your kids is an incredibly important thing, and starting early to educate. I remember when I was a kid, very different environment. I mean, we had a little passbook savings account, and we'd bring my little book, and every dollar I got for my birthday or whatever would go into my savings account. But I still remember that 40 years later in instilling in me, savings are important, investing is important, thinking about planning for the future is important. I was having a conversation with a colleague the other day who actually is doing quite a good job with her two boys, helping them think about budgeting. And, we both kind of came to the realization that more than likely our children are never going to write a paper check. It's a really interesting phenomenon, thinking back, to the world in which where we came. The idea that you can fund an account at birth, that sometimes you can contribute more to, sometimes it just compounds based upon some investment return that can generate real wealth over time, has two sort of added effects, right? The first is you instill in an individual an investment-based mindset. So $1,000, or $500 contributed at birth with $500 annual contributions could be $20,000 at age 18 or age 19, like meaningful money for individuals. The second thing I think it does is really starts to get individuals focused on building wealth at an early age. So the idea, beyond the translation of $500 into $20,000, but the idea that, in order to grow wealth, you need to invest or you need to save, is sort of foundational to virtually everything that we're talking about here. Whether your goal is buying a house, whether your goal is paying for college, whether your goal is getting married, saving for a honeymoon, saving for a vacation, or retiring someday, the earlier we can start engaging children around better savings behaviors, how to invest, the principles of investing, diversification, all of the things that we kind of live and breathe and feel every day, the better off that next generation will be.
I do have kids. I know you mentioned a 10-year-old, but you made me remember back to when I was in high school and I had a job and I was making not much of a hourly wage. But my mom said, well, now you have enough to invest in a mutual fund and you should think about doing that. And I did. And it just instilled a good habit. And, so much of what I think we do as adults is maybe starts at a younger age. Rob, let's bring it back to the present. We've seen a lot of volatility in the market this year. And at one point, retirement accounts took quite a hit when markets sold off before they bounced back. BlackRock actually surveyed investors. Our global family office team surveyed investors, and about 60% of them came back with more of a bearish outlook, just based on what's been going on around things like tariffs and trade policy. But when we're talking about the habits for saving for retirement and building wealth early, how does that translate then to when markets go through a downturn?
Yeah, it's probably one of the things that I get most frustrated about. Individuals, I'd say, either fall into one of two camps. They are either the camp that doesn't engage and just lets it be, or they're in the camp that engages too often. Retirement savings is one of those things that you kind of need to be mindful of, especially early in your career, and you need to save as often as you will. But it's not something you should be looking at every day. You're looking at it every day, you're going to see every up, every down, and you're going to feel every up and every down, to your point on the emotional tie-in earlier. Similar survey to the family office survey that was done of registered voters around the same time showed that almost 40% worry about their retirement savings once a day. Like, that number is where it was because of the market volatility that occurred. What I would say to individuals saving for retirement, specifically those kind of earlier in their working lives, is patience, stay the course, stay invested. I mean, it's the things we talk about often, that time in the market, not timing the market. I get that it doesn't feel great to see 5, 10, 15% decreases in wealth. But as you and I have seen since that period, right, markets have recovered. One of the interesting things that we saw during that period too is that a number of participants, in some cases 5 or 10% of participants, actually increased their savings rates. Right? So think about what is the opportunity, and keeping a long-term perspective is actually really important. So the only way you're going to have adequate savings is by staying invested. The only way that you're going to maintain your standard of living is by continuing to contribute, and contribute more when you can. And keeping your end goal in mind, wealth maximization, so that I can maintain my standard of living and I can go hang out on a boat and you can go, hang out on the islands, or whatever it is you want to do in your retirement.
I don't know if I have that much saved for retirement yet, but I suppose that's a goal. Rob, just to wrap up, as you think about the retirement landscape, and there's so much to try and follow across policy and sort of investor behavior and market volatility, but what are some of the things that you would want investors to think about that they could take action on today?
Yeah, look, I think that the very simple framework I use is everybody that is a potential retirement saver is on somewhere on a continuum. It's the continuum from, am I a saver? Am I an investor? And as I get to retirement, how do I fulfill the spending needs that I need? In retirement land, we have a saying sometimes that doesn't matter really what capital markets do. Nothing can combat an undersaving. So starting saving early, saving as much as you can, compounding as much as you can. This is a universal challenge. This is something that everybody aspires to, but it's going to look a little bit different for me. How you get there is going to be a little bit different than I do. But the things that I think we all know are, the earlier I start saving, the more I save, and tapping into the power of capital markets are going to be how we both get there.
You pointed out that maybe we haven't spent enough time talking about retirement in recent years. I think that's starting to change. Today is a good example of that. And talking about this topic maybe makes people more aware and helps them take some action. Rob, we appreciate you sharing your insights on the retirement landscape. And thanks for doing it here on The Bid.
Now, glad to be here. Thanks, Oscar.
Thanks for listening to this episode of The Bid. Next week, we take stock of what the rest of the year holds for markets as we hear from the BlackRock Investment Institute on their mid-year outlook for 2025. Make sure you don't miss it by subscribing to The Bid wherever you get your podcasts.